Good morning, hunters, and welcome back to the Daily Hunt for Multibaggers on this Tuesday, March 10th, 2026. It's great to have you with us.
Absolutely, Ethan. We've got a packed show today, sifting through a truly impressive volume of data. Our AI models analyzed over 370 social media posts from yesterday, flagging an interesting mix of 9 different stocks for a deeper dive.
And what a mix it is. The overall market sentiment we're seeing is quite dynamic. Some strong optimism and solid fundamentals driving certain names, but also a fair bit of speculative hype, that we need to scrutinize.
Exactly. Today's deep dives revealed a real bifurcation between strong operational performers and those relying heavily on future promise, often with some red flags when you really dig into the key performance indicators.
All right, let's jump right in. First up is AST SpaceMobile Inc., ASTS. The community is absolutely buzzing about this one, seeing it as a real game changer for direct-to-device satellite communication. Users are talking about 10x to 20x potential, strong partnerships, and Alphabet even owns millions of shares. The stock itself is up a staggering 181% in the last year. That's some serious momentum, Brooke.
It's certainly exciting, Ethan, but we've rated ASTS as a speculative gamble or stay away multiple times in the past, and my KPIs are unfortunately still flashing red. While the tech sounds disruptive, the company is still deeply unprofitable, with an EPS of negative 1.34 and a net profit margin of 0. Its price-to-book ratio is an extremely high 13.91, showing massive speculation. Plus, that beta of 2.867 means it's super volatile. We're looking at future revenue projections, yes, but the current financial reality is one of heavy cash burn.
So a lot of potential, but significant hurdles to overcome.
Exactly. For ASTS, our AI-generated insight is to stay away for now. The risks are simply too high for an unprofitable company with such an aggressive valuation.
Next up, we've got Reddit Inc., RDDT. The social media world is always buzzing about itself, right? We're seeing a lot of YOLO posts and bag holders hoping for a massive rebound. There's a strong belief in the platform's network effect and future improvements. Some users are even pointing to a forward PE of 25 as a bullish sign. We've had a mixed bag of ratings for RDDT, ranging from stay away to a buy earlier this year.
Well, Ethan, while the community hopes for a rebound, the KPIs tell a more cautious story, leading us back to a stay-away classification. That PE of 53 isn't matching the optimistic forward PE of 25 some are quoting. And critically, the revenue growth factor shows a decline of over 30%. That's a significant red flag for a growth-oriented company. And let's not overlook the substantial insider selling, representing over 14% of total insider shares. Plus, social media discussions also highlight concerns about platform degradation and regulatory challenges.
So despite the passionate community, the numbers just aren't adding up right now.
Precisely. For RDDT, our market commentary is to stay away. The valuation seems extended given the current growth trajectory and insider sentiment.
Now for a real heavyweight, NVIDIA Corporation, NVDA. This company just continues to impress. One user even turned $50,000 into over 500,000 trading shares. They see it as deep value, even at its current levels, especially with a perceived forward PE of 21, citing its relentless innovation in AI, which, is outshining even Apple and Google. We've rated NVDA as a buy multiple times, and even when it's been stay away, it's often rebounded. Ethan, for NVDA, our AI-generated insights lean firmly towards a buy. While the stated forward PE of 21 is a bit lower than our observed PE of 27, the underlying fundamentals are incredibly strong. We're talking about an exceptional revenue growth rate of 73.2% and an astounding operating margin of 65%, and that return on equity, over 100%. These numbers consistently demonstrate market leadership and highly efficient operations, fully supporting the bullish user sentiment and strategic investments in AI. Hard to argue with those numbers, Brooke.
Indeed. For NVDA, our market commentary is a solid buy.
Okay, let's talk about NextNRG Inc., NXXT. The social media landscape is absolutely alight with bullish sentiment for NXXT. We've seen multiple posts touting it as a company uniquely positioned to benefit from potential fuel shortages due to geopolitical events, expecting cash flow tailwinds and a significant market re-rating. They're talking about new federal energy infrastructure and defense projects, even strategic investments. We've typically rated NXXT as a stay away or speculative gamble in the past, but the optimism is really building.
Ethan, the community optimism is palpable, but this is one where the KPIs are screaming danger, making it a stay away. Despite all the future talk, NXXT is currently deeply unprofitable. We're looking at a net profit margin of a shocking negative 86% and negative EPS. The most concerning, however, is a price-to-book ratio of negative 4.37, which indicates that the company's liabilities actually exceed its assets. The stock is trading near its 52-week low, down from 3.59 to 0.55. While the new projects could change things in the future, the current financial health is extremely precarious. A classic case of hope versus hard numbers, it sounds like. Precisely. For NXXT, our AI-generated insight is to stay away due to severe financial distress. Moving on, we have W&T Offshore Inc., WTI. This is a company we haven't discussed before. There's a lot of talk about WTI crude oil prices surging due to global turmoil. If oil prices keep climbing, that's got to be good for an exploration and production company, right? There's definitely some bullish conviction on oil prices out there, and we've even seen some insider buying. While the discussions around crude oil prices are certainly relevant, the social media sentiment is actually quite mixed and even skeptical about sustained high prices. And when we look specifically at the company WTI Offshore, the picture isn't pretty, leading us to classify it as a stay away. Recent news confirmed a Q4 loss and missed revenue estimates. Their net profit margin is a negative 29%, EPS is negative 0.99, and the price-to-book ratio is deeply negative at negative 2.67. This indicates a deeply unprofitable company with negative shareholder equity.
So the tide of rising oil prices might not lift this particular boat, you're saying?
Not without a complete turnaround in its core financials. For WTI, our market commentary is to stay away.
Next up is Restaurant Brands International, QSR, another new one for our show. Some social media users are highlighting it hitting fresh highs, positive analyst sentiment, and a mention of activist investor Bill Ackman's historical bullishness. Plus, their Burger King brand is making marketing moves, and they're expanding with Gongcha. We're seeing insider buying here too, so that's encouraging.
You know, Ethan, the social media deep dive on QSR actually presented a strong bearish case when comparing it to industry leaders like McDonald's, and that's why we're classifying it as a stay away. Its operating margin of 26% is half that of its meat competitor, suggesting significant operational inefficiencies. The analysis also pointed to poor capital efficiency, but the biggest red flag for me is the incredibly high debt-to-equity ratio of over 300%. While they're expanding and showing revenue growth, that level of debt introduces substantial financial risk, especially for a stock trading at a PE of 27.
So, despite the market enthusiasm, the underlying fundamentals suggest caution.
Absolutely. For QSR, our AI-generated insight is to stay away. The high debt and lower efficiency pose significant challenges.
From QSR to its rival, McDonald's Corporation, the social media analysis really highlighted McDonald's terrifyingly efficient business model, calling it a ruthless real estate cartel masquerading as a clown. Users applauded its superior profitability and excellent capital efficiency, noting it's consistently performing and insiders are even buying shares. We've rated McDonald's as a buy multiple times in the past.
Ethan, for MCD, our market commentary is a definitive buy. The numbers truly speak for themselves. An operating margin of 45% is outstanding, indicating incredible operational efficiency. The company demonstrates healthy revenue growth of nearly 10% and has a remarkably low beta of 0.496, meaning it's much less volatile than the broader market. While the PE of 27 is on the higher side, it's well justified by McDonald's consistent performance, structural advantages, and a reliable return of value to shareholders through its dividend.
A real picture of stability and efficiency in the fast food space.
Precisely. For MCD, we classify it as a buy.
Shifting gears back to tech with Advanced Micro Devices Inc., AMD. This stock has seen incredible momentum, up over 100% in the past year, driven by strong revenue growth of 34% and significant insider buying. It's a key player in the semiconductor space, and the community sees its AI partnerships as a big growth driver. We've recently had AMD as a buy or cautious buy.
Ethan, while AMD has had impressive past performance, our AI-generated insights suggest a stay away for now. Its PE ratio is incredibly high at 77, indicating extreme overvaluation given its current earnings. Adding to the concern is a very high debt-to-equity ratio of 6.359, which signals significant financial risk. Despite the strong revenue growth, its return on equity is relatively low at 7%, suggesting less efficient use of shareholder capital for a company with such a premium valuation. Plus, some social media discussions point to institutional capital rotating away from megacaps, and news about Apple's M5 Max outperforming AMD highlights ongoing competitive pressures.
So the risks outweigh the recent growth at this price point.
That's the read, yes. For AMD, our market commentary is to stay away.
And finally, we wrap up with Alphabet Inc., Google. Google is making serious waves in the AR/VR space, having officially released an AR glasses prototype and partnering with Samsung and Qualcomm for smart glasses development. They're investing heavily in future tech like Waymo and Wing, outperforming the broader market, and critically, insiders are buying millions of shares. We've consistently rated Google as a buy. For Alphabet, our AI-generated insight continues to be a buy. They exhibit strong fundamentals across the board, 18% revenue growth, a net profit margin over 32%, and impressive returns on equity and assets. The significant insider buying is a powerful vote of confidence from those closest to the company. While the PE of 28 is certainly not cheap, it's justified by Google's consistent innovation, market dominance, and strategic positioning in high-growth areas like AI and AR/VR, which have strong potential to drive future revenue and profitability.
Another tech giant showing no signs of slowing down.
Indeed. For Google, our market commentary is a buy.
All right, hunters, that was a truly fascinating deep dive into today's hot leads. Brooke, let's give everyone a quick roundup of the stocks they might want to investigate further.
Investigate as buy: NVIDIA Corporation, NVDA, McDonald's Corporation, MCD, Alphabet Inc., Google. Investigate as cautious buy: none. Investigate as speculative gamble: NextNRG Inc., NXXT. And that wraps up another episode of the Daily Hunt for Multibaggers. Remember, this podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset. Thank you for joining us on the Daily Hunt. We'll be back tomorrow with more AI-generated market commentary. Happy hunting, everyone.